Hi there, and welcome to the Stockscores Market Minutes for September 4th, 2012. This week's topic, the basics of stock chart reading. In addition to my weekly stock market analysis, I'll provide you a little lesson on how to read a stock chart. All right, let's get right into that then. There are 6 things that are important to understand if you are going to be able to interpret the price and volume behavior for a stock. They are support, resistance, optimism, pessimism, price volatility, and abnormal activity. Now, I'll show you each of these things in just a moment, but once you understand these simple 6 things, you can read the chart of anything that trades with some liquidity. Now, it's important to begin with the concept of price inflection points. These are the price levels where price either stops going up and starts going down, or stops going down and starts going up. I'll show you that in just a moment. We use these to define those 6 elements of the chart pattern. Now, chart patterns can be found on many different time frames. You can get a different message from an intraday chart looking back 5 days compared to a weekly chart looking back 5 years. However, the concepts for analyzing those charts is exactly the same. All right, so let's look at this chart. It is the chart of the S&P 500 ETF, SPY, and I've put some black arrows on this chart to show inflection points. Now remember, I said that an inflection point is drawn at the price level where price changes direction. So you can see that those arrows are either at places where price stopped going down and started going up, or stopped going up and started going down. The idea behind inflection points is that it is the place where control of the market changes between buyers and sellers. If buyers are in control, price is moving up. If sellers are in control, prices are moving down. And where there is an inflection point, there is essentially a change of control. So with inflection points, we can then draw some lines across them to define the pattern. So you can see I've drawn a green line across the inflection point lows here. And that tells us that the market is optimistic because the bottoms are rising from left to right. In places where we have tops falling from left to right, we have pessimism. So that's 2 of our things on our list. Now the next important line is this one, which is drawn across these tops at a horizontal price level. That is an upper limit on what the investors are willing to pay for the fundamentals. In this case, they're willing to pay no more than $142 for the S&P 500 ETF. Every time the market got there, and it got there in late March, April, in May, and again in August, every time it got to that price level, the buyer said, whoa, we're not willing to pay more, and the sellers took back control. Well, that means that there is a psychological threshold there, but it's also a demonstration of what the investment community thinks the fundamentals are worth at the maximum. Now we have a price channel here. I've also drawn a line across the tops in this upward action, and that is a sort of a boundary for the buyers who are in control. When they get to the top of the boundary, they lose their enthusiasm and prices fall back. They rise up again, they fall back. They rise up, they fall back. And you can see that it's happened a number of times over the last few months. Well, there's a message there. The buyers are in control, but they're not super enthusiastic because the slope of this line is not that steep. As it stands right now, the market has hit resistance, and although they're optimistic, we're now making our way back to the lower boundary of that channel, something pretty normal. Now let's go to the intraday chart and we'll be able to see some other elements of chart patterns. So this is still the S&P 500, but in this case it is the 30-day, 60-minute chart. And so we're seeing here, 30 different days, 60 minutes at a time. Well, notice in the last week or two, the tops have been falling. That means that investors are pessimistic over that time frame. And they're falling towards support, which has been hit a number of times. So we're pushing down, testing this resistance. Well, what we have to watch for now is whether we're going to break down through support or whether we're going to break up through resistance on the daily. And that's why the market's at a real critical point. In the next week or two, we're going to get our answer. And of course, in the next week or two, we also expect that the US Fed may do something on interest rates, that the European Central bank may do something on interest rates or stimulative action. There's not a whole lot they can do with interest rates, but at least monetary stimulus. And so those are going to determine whether we break up or down, whether the intraday pessimism gives way to a breakdown or whether the daily optimism gives way to a breakout. Real important stuff and easily understood when you take those 6 elements of chart patterns and look for them on the chart. All right, let's continue with our analysis. Here's the chart of the the TSX 60. And you can see that we broke the cycle of pessimism here earlier in August. We went up pretty quickly and are now retracing back because notice we've also run away from this trend line. Now what I want to see in the near term is a break from this pattern. This is called a flag pattern. A flag because we've got a flag pole moving up and now we're kind of fluttering in the wind here. It's a moment of indecision, but at the same time the break into it was optimistic, and so that's positive. My expectation is we'll form a rising bottom from here, which would be optimism, and then we'll break to the upside and likely continue higher until we get up to resistance there. So I'm optimistic about the Canadian market, but I would like to see that break out of this flag to really be real optimistic. Now this is the chart that I don't normally show, but it's an important one and was highlighted by one of my subscribers to my newsletter today because it is the chart of the Russell 2000 and it broke from that little flag pattern today. You can see that it's been generally trending slowly higher over the last little while. It went sideways for a few weeks and then today it made a little upside breakout. Now that's important because this index, the Russell 2000, which is smaller cap stocks, has really been a laggard to the bigger indexes like the Dow 30, the Nasdaq 100, and the S&P 500. And that's important because as traders, we actually make our easier money trading the smaller cap stocks. They tend to move quicker. They tend to move with more enthusiasm. And there really hasn't been enthusiasm in this sector. Well, today, we got a little bit of a signal that that enthusiasm may be coming back. And that is a real strong sign for traders who maybe have felt this past summer has been a dead time for the market. Really, it has. And so I'm feeling pretty optimistic as we go into September here, even though September is notoriously a bad month. This is one sign that the market is getting better for traders. And we'll look at some others in a moment. Here's a chart of the 20-year bond. This is TLT, an ETF that represents 20-year treasuries put out by the U.S. government. Well, notice we had a top here and then a higher top, and we may now form a falling top. Now remember, falling tops, sign of pessimism. We've already broken this upward trend line. We did that there, so that optimism was broken. We still have an upward trend drawn here, but if we can break down from this level, that would be bullish for stocks because if money moves out of treasuries, if it moves out of the safety of bonds, it's going to land somewhere and a lot of that money is going to end up in the stock market. Now, we haven't seen that breakdown from a falling top yet, so don't get too excited, but I expect that if there is stimulative action by the US Fed or by the European Union, we will get that breakdown. US dollar is generally in an upward trend over the last year. And that's because generally the U.S. economy is doing better than most economies around the world. Over the last month to 6 weeks, we have pessimism. And that's because the market is looking toward some kind of stimulative action, the printing of money by the U.S., which would lower the value of the U.S. dollar. However, we got to be a little bit cautious here because although people expect that the printing of money will cause a break of the optimism, it may be that if everybody, all the major economies in the world are printing money to help fix their problems domestically, that maybe the U.S. economy actually fares the best because it appears to be the one coming out of the recession first, and it therefore may attract investment which would be stimulative for the US dollar price. So I'm a little bit torn here. We're right at support where the market should bounce, and I wouldn't be surprised if we see a little bit of a bounce in the US dollar and the US stock market go up in tandem, even though that wouldn't be what we would expect normally. Gold is an important chart because in the last week it has broken its downward trend. This downward trend has been underway for a number of months. I've been pessimistic on gold for a number of months, but I switched my view just on Friday because it broke that downward cycle in gold price. And that is an important sign because it means that the market is expecting stimulative action by the world's central banks. Now, oil ran down sharply here. That was very strong pessimism because the steepness of the line was steep. We have retraced back to the long-term downward trend line. That means the market is still pessimistic, but it is now testing this boundary here. My expectation is we probably break down, but we are at the point where we're going to get something very soon. Either a break of the downward trend line or a breakdown here is going to happen soon because we have come into a very narrow, low volatility point at support and resistance where action should commence. So I am neutral on US stocks, but hey, we could change that view in a day with a break up or down on one of those charts that I showed you. Optimistic on Canadian stocks. They are playing catch up to the US and they should go higher if there is stimulative action out of the US Fed. Gold, I'm optimistic right now because it has broken that downward trend line. Oil, neutral, slightly negative, I would say. Markets are trading with low volatility and below resistance right now. This brings the potential for a significant move in the short term, but we need to see that break to know the direction. We need to see either a breakout on the US market on the SPY, or we could see a breakdown on the intraday chart, which would be pessimistic. So for now, I want you to remain cautious, but watch the market closely. Early signs indicate a rally is coming, but we still need to see that break. Well, that has been the Stockscores Market Minutes for September 4th, 2012. A reminder to subscribe to my YouTube channel. Just subscribe to youtube.com/stockscores.com, where the word dot is spelt D-O-T, or subscribe to my weekly newsletter. It's all free, available at stockscores.com/newsletters.asp. Have a great week in the market and trade well.